The stock market's taken a bit of a tumble lately with those big tech companies, leading the way down.
Yeah.
The Magnificent Seven, they call them.
Right.
Tesla, Nvidia, all those, they're down quite a bit. And that's pulling the whole S&P 500, NASDAQ 100 with them. Kind of strange considering how well the market's been doing all year, don't you think?
It is a little unusual, especially because right now trading volume is pretty low, which tends to make these market moves even bigger. Happens a lot around holidays.
Oh, right. New Year's coming up. But is that all this is? Just typical holiday stuff?
Well, there are a few things going on, actually. You got those big investors, the pension funds and such. It's the end of the year, so they're rebalancing their portfolios.
Rebalancing, huh? What does that even mean?
So they basically adjust their holdings to keep a specific mix of assets. Like, if some investments did really well this year, they might need to sell some off to bring things back in line.
I see. And all that selling pushes the market down.
Exactly. And get this, there's some evidence that there's one really big player out there selling a huge chunk of stock. People tried to buy the dip on the S&P 500 at a certain level, but it didn't work. So somebody's out there with deep pockets, messing with things.
A mystery seller, eh? That's kind of creepy. Happens a lot.
Who knows who it is, but yeah, someone with enough money can definitely move the market like that. And when they do, all the short-term traders jump in and make it even crazier.
So what about these tech valuations? They've been sky high all year. Is this a sign of a bubble about to pop or just a bump in the road?
That's the million-dollar question, isn't it? You got some folks like Kenny Palkari who are still pretty optimistic.
Optimistic how?
Well, they figure the market's already done so well this year, this dip doesn't really mean much in the big picture. But then you got others like Jason Pride and Michael Reynolds over at Glenmead. They're saying, hold on, high valuations might not guarantee a crash, but it definitely makes things riskier, especially if those earnings don't meet expectations.
So what are they saying we should do, these guys?
Diversify, diversify, diversify. Don't put all your eggs in one basket.
Right, spread the risk.
Exactly. Now, on the other hand, you've got people like John Belton at Gabelli Funds. They're still bullish on tech, especially with all this AI stuff taking off. They're saying strong earnings and AI's potential outweigh the risks.
But they're not ignoring the risks, right?
No, they're definitely saying caution is still warranted. And then you got folks like David Miller at Catalyst Funds. They're flat out saying AI is so big, it justifies these crazy valuations.
Lots of different opinions. Makes you wonder. This bull market we're in, it's been pretty short, hasn't it? And the gains haven't been as big as what we've seen historically.
You're right. If you look back at bull markets with similar characteristics, late cycle, high valuations, they usually last around 38 months on average.
38 months, huh? So this one's shorter than usual.
It is, yeah. And Pride and Reynolds, those guys we talked about, they're suggesting we take a more neutral approach to risk, especially for those balanced portfolios. Makes you think.
It does. And you know what else? Tom Essay from the Sevens Report. He's saying all that euphoria we saw earlier in the market, it's kind of died down.
Interesting. So maybe folks aren't as excited as they were before. But you know what I find strange?
What's that?
Advisors seem to be less bothered by this dip than regular investors. Could be a bit of a disconnect there, which might make things even more volatile down the line.
Huh, that's something to think about.
It is. Yeah, so maybe advisors are thinking more long term. But let's get into the numbers, shall we? How'd those key indices actually perform during this little dip?
Yeah, give us the rundown.
Well, the S&P 500 ended down 1.3%, so pretty broad decline across the board. NASDAQ 100, that tech-heavy one, that took a bigger hit, down 1.5%. Shows you how sensitive that sector is right now.
Makes sense. What about the Dow?
Dow Jones Industrial Average, that one slipped 0.9%. So even those big established companies are feeling it.
Interesting. And what about those more specialized indices, the ones that really zoom in on specific areas?
Right. So the Bloomberg Magnificent 7 Total Return Index, the one that tracks those 7 big tech giants, that plunged 2.1%.
Ouch, that's a big drop.
Yeah, no kidding. And the Russell 2000 Index, that focuses on small cap companies, that one fell 1.9%. So it's not just the big guys, the little guys are hurting too.
So a pretty widespread downturn. What's the takeaway from all that?
I think it shows that investors are getting a little jittery, maybe rethinking how much risk they're comfortable with.
Makes sense. So while all this was happening with stocks, what about bonds and currencies? How'd they fare?
Well, the yield on 10-year treasuries, that went up 3 basis points to 4.61%.
Okay, and what does that tell us?
Means investors are looking for safer bets. Government bonds are seen as pretty safe, so that upward move in yield suggests a bit of a flight to quality, as they call it. People are getting out of riskier assets like stocks and moving into those safer havens.
Got it. So bonds bonds went up. What about the dollar?
Dollar stayed pretty stable, actually. The Bloomberg Dollar Spot Index didn't move much. Euro was basically flat against the dollar, trading at 1.0426. But the British pound, that actually gained a bit, up 0.3% to 1.2568.
So the pound did all right.
Yeah, could be a sign of things looking up in the UK, economically speaking.
Interesting. Now, can't forget about crypto. What happened there? Did Bitcoin and all that go crazy with the rest of the market?
Well, Bitcoin, the biggest one, that actually dropped, down 1.3% to $94,458.76. So even digital assets aren't immune to this risk-off mood.
Right. So if even Bitcoin's falling, that's saying something.
It is, yeah. But then get this, Ether, the second biggest crypto, that actually went up a bit, gaining 0.6% to hit $3,353.68.
Whoa. So one goes down, the other goes up. Typical crypto, right?
Yeah, always a wild ride with those. Shows you how unpredictable that market is, separate from traditional finance, driven by its own weird factors. You got to be careful with that stuff.
Absolutely. Okay, so we've talked about stocks, bonds, currencies, crypto. What about commodities? What happened with oil and gold and all that?
Well, oil prices actually held up pretty well. West Texas Intermediate crude, that rose 1.5% to $70.66 a barrel. Seems like demand for energy is still strong, despite all the market worries.
Interesting. So oil's up. What about gold?
Gold, which is usually seen as a safe haven, that actually dipped down 0.6% to $2,618.74 an ounce.
So oil up, gold down. What's going on there?
Well, with oil, it's probably a bunch of things, geopolitical stuff, maybe some supply issues, and just overall demand staying strong. But with gold, it could be that investors are looking at other safe havens, like those government bonds we talked about. Plus, when interest rates go up, gold becomes less attractive because it doesn't pay any interest.
Right. So looking at all this movement across different types of assets, it seems like things are getting pretty complicated out there. What's the main takeaway?
I'd say it's a mix of things, like we talked about, end-of-year portfolio adjustments, that big mystery seller out there, and just general concerns about whether those tech valuations are too high. All of that's pushing people towards a more cautious approach.
Cautious, meaning they're expecting things to go down.
Not necessarily, but they're definitely not as gung-ho as they were before.
Makes sense. So things are in a bit of a transition right now.
Yeah, I'd say so. Lots of uncertainty, mixed signals. Got to pay attention to the details and see how things play out.
Absolutely. Now, before this dip happened, there was some interesting data coming out of EPFR, that company that tracks fund flows. What were they seeing?
Yeah, so they were noticing a lot of money coming out of cryptocurrency funds, record high redemptions, actually. So even before the market dipped, people were pulling out of crypto.
So that suggests they were already getting nervous even before things started going down.
Seems that way. When the market's uncertain, people tend to move away from risky assets like crypto. Too much volatility.
Makes sense. What about tech funds? Were they seeing any outflows there?
Actually, yeah. Tech funds were also seeing outflows, and this has been going on for a while, since early 2023. So even though the market was still going up overall, some investors were already pulling back from tech.
Interesting. So they were sensing something was off, even though the market seemed to be doing well.
Maybe. Could be they were anticipating a correction and decided to reduce their exposure.
Smart move if that's the case. Shows you the importance of staying informed and being ready to adjust your strategy.
Exactly. Market sentiment can change quickly, so you got to be on your toes.
Absolutely. Now, we've talked about how this recent volatility seems to be hitting regular investors harder than professional advisors. What's going on there?
Yeah, Tom Essay, he's the one who pointed this out. He said, advisors have basically shrugged off these recent dips, while individual investors are getting more and more spooked.
So advisors are staying calm while regular folks are freaking out.
Pretty much. Advisors are probably thinking long-term, sticking to their plans, not letting the short-term ups and downs rattle them.
So why are regular investors reacting so differently?
Well, it could be a few things. Maybe they're just less experienced, haven't seen as many market cycles. They get caught up in the headlines, panic when things start going down. Plus, they might have shorter time horizons for their investments. Advisors, on the other hand, they've been through this before. They know these dips happen, and they're more focused on the long game.
So basically, they're less emotional about it.
Exactly. They have the knowledge and experience to stay cool under pressure.
Makes you wonder if this difference in reaction could actually make the market even more volatile.
It definitely could. Imagine this. Something happens, bad news comes out, and individual investors start selling everything in a panic. But advisors, they're staying put, not reacting.
So the panic selling drives prices down even further.
Exactly. Becomes a self-fulfilling prophecy.
And SA mentioned a couple of things that could trigger that kind of panic, right?
Yeah, he said negative political news or any hint that the Federal Reserve might pause those rate cuts that could spook people.
So basically anything that shakes their confidence.
Right. And that's why it's so important for investors to have a plan, stick to it, and not make rash decisions based on fear. And of course, getting advice from a professional never hurts.
Definitely. So we've covered a lot of ground here. Year-end rebalancing, that mystery seller, tech valuations, fund flows, investor sentiment. Anything else we should touch on before we wrap up? So it sounds like we're at a bit of a crossroads here. This tech dip, it's not just about the holidays, right? It's this whole mix of things.
Yeah, exactly. You got those year-end adjustments, that big seller lurking in the shadows, and then the question of whether tech can keep up this amazing performance.
Right, right. And on their own, maybe none of those things would be a big deal.
Probably not, but put them all together and yeah, it's enough to make people nervous.
So the big question is this just a healthy correction or is it a sign of something worse to come?
That's the million-dollar question, isn't it? And unfortunately, there's no easy answer. You got some experts who are cautiously optimistic, and then you got others who are practically yelling bubble. Just goes to show how tricky things are right now.
So what do we do? Just wait and see.
Pretty much. Keep an eye on things, see how these different factors play out in the coming weeks and months.
Stay vigilant, pay attention.
Exactly. The market's always talking to us, sending signals. We just got to listen carefully and make smart decisions based on what we hear.
Well, this has been a really insightful conversation. Thanks for breaking it all down for us.
Happy to do it.
Until next time, goodbye.